Investors, what a week we had in the market this past week. Between the latest jobs report to Jerome Powell's remarks, we have a lot to unpack today, on top of 5 dividend stocks for you to add to your watch lists. But before we dive in, if you are brand new to the channel, I'm Ari, your value and dividend investor here on YouTube, looking to help any and all investors journeying to their next financial milestone by way of providing economic insights and stock ideas. So if that's up your alley, do me a massive favor in tapping on that thumbs up button to let me know, and of course do us both a favor by subscribing to the channel to never miss a single video. Now investors, let's dive right in. Well, let's start off with the good news, shall we? The good news for me at least, and that is that my account, given all the recent rallying, has climbed to $109,386.34, but I am certainly not going to be surprised if we lose some of that steam over the coming weeks and ultimately experience a ton more pain. Now, why do I say that? Well, I want to go back to 2 Fridays ago when the jobs report was released and the US economy added way over the expected 187,000 jobs, coming in at 517,000 jobs. Investors, that is over 500,000 jobs added, which resulted in distressed economists and investors as the unemployment report depicted yet another decrease in unemployment to 3.4% as opposed to the expected and desired 3.6%. which is all making for an incredibly strong labor market that seems to be only getting stronger when the Fed is trying to crush inflation by essentially raising rates, which would effectively raise unemployment levels. So what should we expect? Well, I want you to hear it directly from Powell himself, from his remarks made at the Economic Club in Washington, D.C., where he spoke this past week. Have a listen.
So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. So the services sector, really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And I want to say again, you know, we throw these numbers around, but the reality is we're going to react to the data. So if we continue to get, for example, strong labor market reports or higher inflation reports, it may well be the case that we have to do more and raise hikes more than is priced in. That we have a significant road ahead to get inflation down to 2%, and I think there's been an expectation that it'll go away quickly and painlessly, and I don't think that's at all.
Now, the key takeaway from what was about 38 minutes worth of an interview was Powell tripling down, as heard from the clips, on the fact that we can expect a bumpy road ahead as the Fed will continue to jack up interest rates. So yes, inflation may be coming down, but it's wage inflation that remains the Fed's biggest dilemma, and until we see more layoffs sector to sector, I'm here to say that we will not be entering a bull market anytime soon, which leads me to the first of 5 dividend stocks that I want to bring to your attention today. So without further ado, let's talk about Celanese, ticker symbol CE, which is a massive global chemical leader producing differentiated chemical solutions and specialty materials used in a plethora of major industries. For a better understanding of the role that Celanese plays in our everyday lives, their chemicals can be traced to adhesives, appliances, and automobiles, to medical devices, film strips, fibers, to paint coatings, and right down to the very sweeteners for food and beverages. So talk about an ultra-safe investment, you have it with Celanese. And it's even better that Buffett's stamp of approval is all over Celanese. Ultimately, we are talking about a $13.17 billion market capitalized industry leader that is currently, to our benefit, down on the year, trading for roughly $121 per share, which is about 22% down from this time last year. Now, I would like to believe that the overall market conditions with demand cooling across industries has ultimately led to pain for Celanese, but as a long-term investor, this is merely an opportunity when its PE ratio is sitting at just 8.2. As for smart money, we see plenty of hedge funds taking full advantage of a discount opportunity, inclusive of Buffett himself continuing to add more shares of Celanese to the Berkshire Hathaway portfolio. And let's not forget about analyst optimism here, with over 6.8% worth of upside expected, with a share price climbing up to $129.80 per share predicted for Celanese. Now, as for their dividend, Celanese pays more than the sector average, coming in with their dividend yield at 2.24%. Up next, another rock-solid dividend stock investors can rely on as it chugs right along. We have Union Pacific, ticker symbol UNP, which I personally have not mentioned on my channel before, but have always applauded its safety as an investment, given Union Pacific operates North America's premier railroad franchise that covers 23 states in the western two-thirds of the United States. That's over 32,000 miles worth of rail, with over 8,300 freight hauling cars transporting goods that we all rely upon daily. So when this $127.35 billion market capitalized railroad leader goes off the tracks, its share price slides to around $207 per share, which is roughly 14% off its peak from this time last year. It certainly gets my attention, and I am not the only one with an interest in Union Pacific, as smart money begins to double down on this railroad behemoth, especially with its PE ratio at just 18.5. Now, I think it's also notable to mention that Union Pacific was founded back in 1862, and while transportation of goods has certainly changed since, Union Pacific is one of those companies that, one, could advance along with market trends, but moreover will continue to be reliable for goods transportation. So pain now due to less demand makes for opportunity, which is what analysts foresee as well, as we can see a forecasted share price of $224.05 per share, making for over 8% worth of upside. And with some patience until Union Pacific rebounds, shareholders will enjoy an above sector average dividend, with their dividend yield coming in at 2.43%. Now, investors, this next dividend stock I've mentioned time and time again, but I'm here to talk Tyson Foods, ticker symbol TSN, once again because I'm here to help you beef up your dividend portfolios with what are hopefully long-term profitable opportunities. Tyson, as I have shared before, is the largest beef, chicken, and pork processor in the United States and among one of the largest exporters of animal product within America. Currently, Tyson is helping to feed just about 1/5 of America's meat eaters, and with a market capitalization well over $21 billion, enough balking. This opportunity is looking better and better. Now, did Tyson just post another quarter worth of lackluster earnings? Yes, but we all need to take a moment to realize that macros matter. Right now, consumers have been and will likely continue to shift their purchasing patterns in response to where we stand economically, aka looking to cut costs in penny pinch. Now, on the other hand, meat packers are forced to pay more for transport, as well as incur the costs of more expensive animal feed and higher wages for plant workers. So, on all ends, Tyson is truly taking a beating, hence why we see the stock down over 37% on the year, trading for just under $60 per share. But with a PE ratio at 8.7, along with near-term analyst optimism, the share price rising to $61.25 per share, and smart money beginning to invest into Tyson, I very well may invest a couple $1,000s into Tyson and simply kick back to relax in the pasture, as I collect on their higher than sector average dividend yield coming in at 3.03%. Next up, I want to jump back into the logistics sector, but this time soar above the rails with United Parcel Service, ticker symbol UPS, which has grown to become one of the world's largest shipping carriers since its founding in 1907, and it only continues to dominate the market today as an incredibly competitive logistics leader. UPS has been able to amass a whopping $161.17 billion market capitalization, but just as the rest of today's mentions, has been unable to withstand the pain of unfavorable economic conditions, resulting in its share price sliding by almost 15% to $186 per share. But this is once again just another opportunity for investors, with its PE ratio sitting at just 14.1, and with a future where shipping demand will likely pick right back up. UPS is seeing upside predicted by analysts, with the share price climbing back to $196.94 per share. That's roughly 5.6% worth of upside. As for smart money, hedge funds have certainly been all over this opportunity recently, scoring more shares worth of UPS. But the real win for dividend investors like us comes in from their above sector average dividend yield, to which UPS is shelling out a dividend with a 3.23% yield. And finally, a never before mentioned financial sector investment. Let's talk about a small but mighty bank and insurer headquartered out of Ohio. Its premier financial, ticker symbol PFC, which was founded back in 1920 and has flourished over the years, now operating full-service branches and ATMs throughout Ohio, Indiana, and Michigan. Rather recently in 2020, there was a rebranding following a merger and the company expanded operations. Now, although we're only talking about an $8.94.49 million market capitalized banking investment, let's talk about that PE ratio at 8.9 and the ability to capitalize on it when many investors are going after much larger banks like JP Morgan, Bank of America, or Wells. We should not neglect the smaller ones that, similar to large banks, have been beaten down. Premier Financial, in our case, has fallen by 15.89%, to which it's trading for just $25 per share. But as interest rates remain elevated, there's a lot of potential here, with analysts forecasting nearly 20% worth of upside. But until then, it is the dividend with such a small bank that actually impresses me, with a hefty dividend yield sitting well above the yields of JP Morgan and Bank of America at 4.73%. Now, investors, there you have it from Celanese, Union Pacific, Tyson, UPS, and Premier Financial, the 5 dividend stocks that I am saying are worth your attention right now and well into this week. As always, do not let my word be the end-all be-all. Perform your own due diligence prior to making any investment decisions, but certainly drop your thoughts on any or all of these dividend stocks with a comment down below. Also, if you learned something new or have taken anything away from today's video, I only ask for your support in tapping on that thumbs up button. But if you are eager for more economic insights and stock ideas like today's mentions, it's in tapping on that subscribe button that will do us all wonders. With that, I will see you all in the next video.